All right, let's get right into it because this is a fascinating one. Have you ever seen a company post some of the best results in its entire history? Just spectacular numbers, only to watch its stock get absolutely crushed? It makes no sense, right? Well, that is exactly what just happened to the ad tech giant AppLovin, and we're going to figure out why.
So check this out. On one hand, you have AppLovin announcing these jaw-dropping results. We're talking revenue growth of 66%. In any playbook, that's a massive home run. But then you look at the market's reaction, and the stock just tanks, dropping almost 20%. Staggering growth met with a brutal sell-off.
So the big question, the one we're all asking, is how on earth is this possible? What is Wall Street seeing that the raw numbers don't show? Let's break it down. Okay, so here's our game plan. We'll start with the paradox itself. Then we'll dive into just how ridiculously good their quarter was. After that, we're going to decode the market's biggest fears. Then we'll get into AppLovin's rebuttal, check out their next big move, and wrap it all up with the final question. Is this a crisis or a huge opportunity? So first up, the earnings paradox. The CEO of AppLovin, Adam Foroughi, he put it perfectly. He said there's a real disconnect between market sentiment and the reality of our business. And that's what this is. It's a classic Wall Street showdown, market perception versus cold, hard performance. To really get what's going on, you have to first appreciate the company's side of the story. I mean, their case is built on some of the most impressive financial numbers you will see from any public company, period. Let's just start at the top. Revenue for the quarter hit $1.66 billion. That's a 66% jump from the year before. For a company of this size, that kind of growth is it's almost unheard of. But get this, it's not just about the growth, it's about the profit. For every single dollar that came in the door, AppLovin turned 84 cents of it into adjusted earnings. An 84% margin, that is an absolutely insane level of efficiency. And to put all this into perspective, in the software world, there's this benchmark called the Rule of 40. You just add the revenue growth percent to the profit margin percent. If it's over 40, you're looking at a top-tier company. Well, AppLovin's score? It's 150, 150. That's not just good. They're playing a completely different sport. Okay, so if the report card is straight E pluses, what in the world is Wall Street so afraid of? Let's try to decode the case against AppLovin. It really boils down to two big anxieties about what's coming down the road. First is the fear of competition, specifically the worry that a giant like Meta could muscle its way into AppLovin's world and just eat their lunch. And second is the fear of AI disruption. The thinking goes something like this. If AI makes it super easy for anyone to create an app or a game, then the value of a platform that helps you find those apps should go down, right? But here's where the story takes a turn. AppLovin's leadership thinks the market has this completely backwards. So let's look at their rebuttal, because frankly, this is where things get really interesting. On competition, the CEO basically says, bring it on. He explains that their market isn't about fighting over one fixed pie. When a competitor like Meta starts bidding more, the whole pie gets bigger. So even if AppLovin's share of the auctions goes down a bit, the total value is so much higher that their actual profits, they go up. It's totally counterintuitive. Now, to get their second point, you just have to remember what AppLovin really is at its core. It's a discovery platform. Its one job is to sift through this enormous ocean of content and match the right person with the right app at the exact right time. So here's the killer argument. If AI creates a total explosion of content, a tsunami of new apps and games, what happens? Well, content becomes cheap, abundant, but the ability to discover the good stuff, that becomes the rare and therefore super valuable resource. So far from being a threat, this AI explosion could make AppLovin's platform more essential than it has ever been. But AppLovin isn't just playing defense here. No way. They are going on offense, pushing hard into a massive new market that could eventually dwarf their already huge gaming business. And that market is e-commerce. Just look at this gap for a second. The top gaming companies who have this platform figured out are running tens of thousands of different ads, but the top e-commerce brands, they're only running a few hundred. That difference right there, that is a gigantic runway for growth, as AppLovin helps those brands catch up. And you want to know if it's working? They revealed that when they spend money to bring a new e-commerce advertiser onto the platform, they make all that money back in about 30 days. That is an incredibly efficient growth engine, and it tells you this new venture is already a cash machine.
And that brings us right back to the heart of the matter. You're left with these two powerful, totally conflicting stories. On one side, you have the market's fear. On the other, you have the company's reality. And that's the tension every investor has to grapple with right now.
Which leaves us with this final billion-dollar question. Is the market's panic a brilliant forecast of future threats that the company just doesn't see coming? Or is Wall Street's fear just creating a massive, massive opportunity that's hiding in plain sight? What do you think?